Welcome to Module 2. This module is called the Introduction to Options. In this module, we start options materials from the basics. Almost anyone who's ever tried to learn options initially finds it very confusing. In fact, to become a true options expert, it takes at least a year or two of practice. Where most people have difficulty is to understand the basic mechanisms of options, its fundamental theoretical principles, the different parameters that govern option pricing, and many others. Our job here is to make this material as simple as possible, and we hope to drastically cut that learning curve down to a few months. The first thing we want to mention is that options are traded in contracts and not in shares. This is so that there's a standardization of the quantity, which makes settlement and squaring off open positions much easier. In the US, one contract is equivalent to 100 shares of a stock, index, or any commodity or anything else. So mostly we'll be referring to contracts, but please bear in mind that all options contracts are equal to 100 shares. In this course, we study the most basic of all options, which is the call option. There are only two kinds of options. We have a call option and the put option. All other strategies are built upon these two basic option types. Understanding the call and put options are therefore fundamental to your understanding of options. The call option is slightly more easier to understand because it's consistent with most people's natural tendency of going long or being bullish in the market. So we'll be covering the call option first. Therefore, many option fundamental concepts are also covered in this course. It's therefore necessary to study this course first before any other in this module. So let's get started. The agenda for this course includes getting a broad understanding of the differences between stocks and options. Then we'll see how options are defined and in particular what a call option is. The best way to understand options is to use real-world examples for both calls and puts. In this course, we'll examine a real-world example for the call option. This example should make it absolutely clear what a call option is. And then we'll look at three different scenarios for call options and understand the perspectives of both the buyer and the seller of an option. Finally, we'll apply our real-world example to Apple options, which will be done on the Thinkorswim real-time platform. The first thing you have to understand with options are that options are a purely mathematical concept. Let's say this again. Options are a purely mathematical concept. This means the way options are priced are based on mathematical formulas. These formulas are all based upon certain parameters of the underlying stock, like its price movement, volatility, and other factors. So it's important that we keep this basic fact in mind all the time. This financial instrument has been created by pure mathematics, and the people who created these formulas, Fisher Black and Myron Scholes, won Nobel Prizes for their invention. This Black-Scholes formula is further explained in a later course on options market structure. So we have two markets here. One is the stock market, and then we have the options market. They are two different markets and they are two different instruments, although they are both inextricably linked to each other. Let's first look at how we approach stocks. If you were buying or selling a stock, you could either buy it at its current trading price, and if you were selling a stock, you would sell it at its current trading price. You cannot buy or sell a stock at a very different price than what it's quoting for. Sure, you can put some limit orders, but even your limit orders may or may not get executed, so you may not even get into the transaction. So stocks trade in a single dimension, and that dimension is where the current price of the stock is. If you buy a stock and it goes up, you make money, and if it goes down, you lose money. In options, you can buy or sell an option at very different prices than what it's trading for. So to give you a simple example, if Apple was trading at a current price of $525 a share, this is the price at which you could either buy or sell a share of Apple today. But using options, you could get paid for buying Apple at $475 today. Or if you already owned Apple, I could get paid now and still sell Apple at $575. And what if I told you that in both these examples, I would actually get paid today for doing these transactions? i.e., not only can I buy or sell Apple at the price I want, but I also get paid an additional amount. You can take a bullish position but still make money if your stock goes down. And you can take a bearish position and still make money if your stock goes up. Okay, so all of this is probably beginning to sound a little crazy. While each of these statements I've made are true and possible with options, we need to back up and get right down to the basics. So, welcome to the world of options. You have to pause here and wonder why these instruments are called options in the first place. And this is because they have several dimensions to them, and you truly have 100 different options for any given situation. I hope this is beginning to sound interesting, because it is. And with options, one pays to have a choice in the future, and that future is the expiry date of that option. All options have an expiry date, and we'll be studying these kinds of details as we go ahead. So let's define what an option is. The buyer of an option has the right, but not the obligation, to buy or sell an asset at a certain price by a certain date. I know this formal definition is not going to be very helpful, but let's just go through it. For every buyer of an option, there has to be a seller or the counterparty. The seller of the option has the obligation to buy or sell the same asset at the same price by the same date. So if the buyer of the option has a right to buy, then the seller of the option will have an obligation to sell. If the buyer of the option bought the right to sell, then the seller will have an obligation to buy. So there are two types of options. We have the call option and the put option. The right to buy is called a call option, and the right to sell is called a put option. These definitions are definitely going to be vague to newcomers. I totally understand, and this is normal. So I'm going to use this course to take you through one small step at a time, and I think this is very important that we not rush through this part. We'll be making use of a real world example which is far better to understand than all of this formal language. So please hang in there with me, and I think you'll benefit from all the simplicity in this course. But let's get through the definitions completely, because we have to do that first. Options are derivatives. Their prices are derived from the price of an underlying asset. So in our context, an option on Apple will be priced based upon the underlying price of Apple. When the price of Apple moves, the price of this option is also going to move. So this is also important. We're talking about two different securities here. One is the stock itself, and the other is the options on the stock. As the price of the stock moves, the prices of the options are also going to move. How these prices move in relation to the underlying stock goes to the heart of understanding the options world. Options exist on most major stocks, indices, currencies, metals, gold, oil, ETFs, bonds, etc. So let's define a call option. The previous definition was definition of an option in general, and there were two definitions there. One was for a call option and one was for a put option. In this course, we are going to focus on the call option. So let's define what a call option is. A call option gives the buyer a right to buy, and the seller of the call option has obligations to sell. Both agree on a price, which is called the strike price. And this option contract will be valid for a certain time period, which is called the expiry. As we mentioned in the introduction, this strike price can be any price that the buyer and seller agree upon to do a contract. It may be close to a stock's current price, but it could be $50 or $100 away from the current price as well. The buyer and seller of options are exactly opposite of each other. One has the right, so the other must have the obligation. And it's up to the buyer of the option whether he or she wants to exercise this right. If the buyer chooses to exercise their rights to buy the stock, then the seller is obligated or obliged to sell the stock. Besides price movement of the underlying stock, there are various other factors that affect an option's price. Now that we've seen how an option is defined, perhaps we can try to imagine what kinds of factors may impact an option's price. Some of this may be intuitive and the others may not. So let's just go through them. In the formal definition, option prices are dependent upon the following: the price of the underlying asset, the strike price of the option, the volatility of the underlying asset, and the time remaining to expiry of the option. The first two factors may be intuitive. We saw that if Apple's trading at $525, then we can construct options at strike prices of $600 or maybe even $300. But the prices of these options will be very different because $600 is about $75 away from its current price of $525, but $300 is about $225 away from its current price. So obviously both options are going to be priced very differently because each has its own probability of success. The third factor is implied volatility, or for now let's just call it volatility of the stock. We've seen that Apple and IBM have different betas and therefore different values for volatility. Some stocks are more volatile than others. So if a stock is more volatile, it has that much more of an opportunity to hit the strike price. So volatility is a big factor in pricing options. The last is time remaining to expire. An option that has 30 days to expiry will be priced very differently from an option that has perhaps 60 days or even 180 days or 1 year to expire. This should be fairly intuitive as well. There are two smaller factors that go into all options pricing models. These are the risk-free interest rates that are prevalent at the time and the dividends paid by the stock. These factors impact option prices very minimally, and although they are input into all options pricing models, in practical terms, they are very often ignored. So let's jump right into a real world example to understand how a call option works. We're going to consider a real world example to understand options. This example is absolutely key to etch the fundamentals of a call option in your mind, so I'd request you to please pay careful attention to this example. We consider the case of a real estate deal or where we have a buyer and a seller of some piece of real estate. Let's just call it vacant land. The buyer likes the piece of land and the seller quotes a price of $1 million for this land. Buyer likes the price but needs time to do due diligence and arrange financing. So buyer wants a hold for 60 days. Buyer and seller agree that a small premium should be paid to the seller, and in return the seller gives him 60 days and locks the price of $1 million until this time. And so they agree that a fair and reasonable premium for this purpose would be $25,000. If after 60 days the buyer declines to buy the land for any reason, then seller keeps the premium. Any time within the 60 days, if the buyer wants to buy the land, he pays the $1 million and he can exercise his right to buy the land at the strike price of $1 million. This is regardless of what the price of land does after this contract has been put in place. So the price of land can go up by a lot, it can go down by a lot, it doesn't matter. If the buyer wants to exercise his right to buy the land, he pays the $1 million and he has the right to buy this land. Likewise, the seller is obligated to sell this piece of land at $1 million to the buyer within the 60 days. And in return, he receives $25,000 for giving the buyer this right. This is a call option. This is a simple example of a call option. The buyer has just bought a call option. Buyer has the right to buy at a certain strike price. Buyer has paid a premium for this right to the seller of $25,000. Seller has the obligation to sell at that strike price by the expiry date, which is 60 days. If the buyer does not buy by the expiry date, seller keeps the premium and the contract expires worthless. Buyer loses the premium regardless of whether he buys or not. And the call option is created on an underlying asset, which in our case is the land. We'll now look at various elements of this transaction and model certain scenarios. Our goal is to understand the dynamics of the various elements of this option. For all scenarios, let's assume that the buyer has no problems getting any financing and that $1 million is the fair value of the price of this property on this date when the option was created. Since the fair value is $1 million and the option strike price is also $1 million, this option is said to be at the money. The meaning of at the money options should be clear, but if it's not, that's okay. For now, let's just say that at the money options are options that have a strike price exactly equal to or very close to the fair value of the underlying asset at the time the options contract was created. We are now going to look at three different scenarios. In scenario 1, in 60 days, let's say the price of land jumps to $1.1 million. So the buyer has been observing the prices of land in that area as part of his due diligence process and notices that land prices are going up nicely. The current market price of that piece of land is close to $1.1 million. So he's gotten a great deal on his option contract. He can exercise his option at $1 million and buy the land at that price. He can turn around and sell it for $1.1 million, but he doesn't have to. He can keep it as long as he thinks the price is going to appreciate. The seller, on the other hand, has an obligation to sell it at $1 million as per the option contract. He has to sell if the buyer wants to exercise. So the seller gets assigned on this contract. The total cost for the buyer is $1 million plus the $25,000 in premium that he paid. So it's $1.025 million. The $25,000 that he paid was gone at the time of the option contract. So he cannot get that back. So his total cost is $1.025 million. So his profit on this deal, if looked at strictly from a financial standpoint, his profit was $75,000. Now look at his capital deployed. His capital deployed was only $25,000, assuming he had a ready buyer at $1.1 million. So he doesn't have to use his $1 million. So his capital was $25,000 and his profit was $75,000. So his return on his investment was 300%. Options are a leveraged instrument, which we'll study a little later, but high returns are possible from options contracts. So there are several learnings from this scenario. The first learning is that the maximum this buyer could have lost on this deal was the $25,000 that he paid for it. Let's say the prices crashed to $800,000 in 60 days. His loss was still limited to $25,000 because he had the right to exercise the contract or not to exercise. Obviously, he's not going to exercise the option contract if the value of the asset drops after he entered the contract. So this is learning number one, or takeaway number one. If you are an option buyer, your loss is limited to the price you pay for the option. However, your profits on the upside are unlimited. As we saw, if the price of the land went to $1.1 million, then the buyer made a profit of $75,000. If the land had to go up to $1.3 million, then the buyer would have made a profit of $275,000. Obviously, such a scenario may not be realistic with real estate, but it is possible when you're dealing with financial assets like stocks. The second learning is that he could control an asset worth $1 million with an investment of $25,000. And this is exactly what leverage is. Another example to understand leverage, which many of us may have experienced, is buying a house worth, say, $500,000. You put $100,000 as down payment, and let's say after 2 years, the house is worth $600,000. So if you sell it for $600,000, your profit is $100,000 and your investment was also $100,000. So you had a 100% profit, even though in real terms your house had appreciated only by 20%. This is leverage at work. Options are a leveraged instrument, and your equity into the house was also a leveraged instrument. We probably took a loan for the balance of the amount, and then when we sold the house, we paid the loan back. The third learning is that the buyer has paid $25,000 for this option, so he really needs the land to increase by at least $25,000 in value for him to make money on this option, because he cannot get his $25,000 back. So if you look at this option transaction from a financial standpoint, the financial break-even for this buyer of this call option is equal to the strike price of $1 million plus the premium he paid for this option, which is $25,000. So the underlying asset, which is the land, must move higher by at least the premium amount for the buyer to be profitable on this deal. And it must do that within the expiry date of this option. So within 60 days, the underlying asset, which is the land, must move higher by at least $25,000 for the buyer to make any profit from this deal. Let's now look at this from the seller's angle. He received a $25,000 payment as premium. Now, this is also the maximum he could hope to gain in this transaction. Let's see why this is the case. If the price of the land starts going up above $1,025,000, the seller of this option would actually start to make losses, because anything above $1,025,000 is money that the seller is losing. So the fair value is $1 million. He received $25,000 as premium. So his break even is also $1.025 million. But anything above $1,025,000, the seller is actually losing money. If the price went down to about $800,000, he would still keep the $25,000 as premium, because no buyer is a fool to exercise an option where the value of the land has fallen. If the land price did not change at all and stayed at $1 million, it's possible that the buyer may still want to exercise that option at $1 million. But the buyer has already paid $25,000 in premium. So the seller stands to gain this amount if the price does not move or if it goes down. But his gain is capped at $25,000. However, his losses are unlimited if the value of the land keeps going up. Buyer and seller have the same break-even at $1.025 million. And buyer makes a profit if it goes above that number, and the seller makes a loss if it goes above that number. In our example, if the price went to 1.1 million or 1.3 million, all of the increase above 1,025,000 was losses to the seller, because if he wasn't bound by his option contract, he could have pocketed that profit. So as a seller of options, your profit is limited, but your losses are unlimited. So at this point, you may be thinking, why on earth would anybody want to be a seller of options? It's a great question, and I'm afraid you'll have to wait for the answer. And the answer will surprise you. Let's look at scenario number 2. Assume that the buyer is very confident that the land prices are going to go up and that in 60 days he's sure it's going to be at least $1.1 million. So he tells the seller that he's not interested in an option at the $1 million price, but wants an option to buy the land at $1.1 million. The seller is rubbing his hands with the smell of profit. Not only can he pocket a premium for the option, but if the buyer decides to exercise that option, he can sell the land at a price of $1.1 million. But obviously, he cannot expect a premium of $25,000 for this option, because this option is out of the money. The buyer is taking additional risk because now the price has to climb to at least $1.1 million plus the premium he pays for this option for him to break even. So obviously the premium for this option will be much less than the option that had a strike price of $1 million. The strike price of $1 million was at the money because $1 million was considered to be the fair value of the land at the time the option contract was created. So the $1.1 million strike price is called out of the money. They negotiate and agree that a premium of $10,000 is fair and reasonable for the strike price of $1.1 million. So the buyer pays $10,000 and they get into an option contract with a strike price of $1.1 million. So this is getting interesting now, and various things can happen. First, let's say that the buyer was right and the price does go up and it goes up to even $1.2 million. The buyer paid $10,000 for this option and he exercises his right at $1.1 million. So he has a profit of $90,000 on an investment of $10,000. His return is 900%. The seller's break-even price would have been $1.1 million, so he lost $90,000 on this deal. So for a premium payment of $10,000, he lost out on $90,000. But if he looks at it from another angle, he got the $10,000 premium upfront and he got to sell the land at $1.1 million, which was $100,000 more than the going price when the contract was created. So it seems like both made out okay on this scenario. But did the buyer really do a smart thing by buying an out-of-the-money option? He certainly paid much less premium for this option, but what were his chances that the land would actually surpass his strike price of $1.1 million and then go past his break-even point of 1.11? Obviously, his chances were much less of this happening with this out-of-the-money option than the earlier scenario where he bought an at-the-money option but paid a bit more premium. So, takeaway here. Out-of-the-money options will be much cheaper than at-the-money options for a buyer, but for the deal to be profitable, the underlying has to move by a lot more by the expiry date for the option buyer to make some money. For a buyer of out-of-the-money options, probability is against him. And for a seller of out-of-the-money options, probability is on his side. But if the out-of-the-money option does become profitable for the buyer, then the return on his investment is probably going to be much more because his investment was much less. Let's consider scenario 3. The buyer wants the same 60 days time but wants the seller to sell him an option to buy it at $800,000. So the seller is confused now. If the land is already worth $1 million, why would he sell it at $800,000? But he gets an idea. He knows the value is already $1 million, and so if he sells an option at a strike price of $800,000, then he must capture that extra $200,000 value right now. So he adds $200,000 to the $25,000, which was the premium for the at-the-money option in scenario 1, and quotes a premium of $225,000. Buyer agrees and they make the deal. This scenario is for illustrative purposes only. But the point is, the buyer has now bought an in-the-money option. Because the value of the underlying, which is the land, is already above the strike price, this option is said to be an in-the-money option. And it is in the money by exactly $200,000. This $200,000 is called the intrinsic value of the option. This is the value the option will have if that option were to expire today. And any value that's left over after the intrinsic value is the extrinsic value of that option. So in our case, if the buyer paid $225,000 for this option, the extrinsic value of this option is $25,000 and its intrinsic value is $200,000. So as long as there is time left for the option to expire, there will always be an extrinsic value or time value. And intrinsic value is the value by which the option is already in the money. This is the difference between the current price and the strike price of the option if the current price of the asset is already higher than the strike price. So now let's look back at scenarios 1 and 2. What was the intrinsic and extrinsic values of the options in scenario 1 and 2? In scenario 1, the option was exactly at the money at $1 million and the premium was $25,000. In scenario 2, the option was out of the money and the premium was $10,000. The answer is, in both cases, there is no intrinsic value at all. Even an at-the-money option, where the underlying asset, which is the land, is exactly at the strike price, there is only extrinsic value or time value. Now, if the land value of the $1 million at-the-money option moves higher by 1,000, then its intrinsic value becomes 1,000. So, at the money and out of the money options will not have any intrinsic value. They have only extrinsic value. Out of these three scenarios, we are going to consider that the buyer and seller went in for the at the money option at $1 million. This is the simplest example to understand, so that's what we're going to consider. So let's just look at both the buyer and the seller perspectives again. Buyer pays the premium of $25,000 and needs the price of the land to move up by at least that much. Must move past the strike price plus the premium for the buyer to make any money. This premium paid cannot be recovered unless the price of the land moves up. Above the $1,025,000, the buyer has unlimited profit potential. Even if the land goes down to $800,000, the buyer will lose only the $25,000 that he paid in premium and nothing more. For unlimited profit on the upside, the seller has unlimited losses on the same side. For limited losses on the downside, the seller has limited profits on the same side, which is the downside. From the seller's angle, the seller gets the premium of $25,000 and would like the land to go down or stay flat. Again, we are strictly looking at it from a financial standpoint. No seller would like the price of his land to go down. So the best case scenario for the seller is if the land stays flat or goes down. The premium of $25,000 is the maximum profit for the seller in this transaction. Above $1.025 million, the seller is exposed to unlimited risk. And even if the land goes down all the way down to $800,000, his maximum profit is only $25,000 because the buyer is not going to exercise his option. So, if you look at it from the risk and reward profile of both the buyer and seller, this profile does not seem fair. It seems to be tilted towards the buyer. So, what's the catch? There are some things going for the seller, and some of these things may not be very obvious. So, let's just review the seller position again. The burden of price movement is on the buyer's position. So, the land must move higher past the 1 million price and by an amount equal to the premium, so 25,000. So the land price must move higher past this $1 million and 25,000 for the buyer to make any profit. And this price move must happen within the next 60 days. So time is working for the seller, because as we approach expiry and the price of the land has not moved or has gone down, then the seller gets to keep this premium. So seller is benefiting from what we call time decay. And probability is also on the side of the seller, because once you add the premium amount to the strike price, which is 1 million plus the 25,000, this break-even price of 1,025,000 is out of the money, because at the money is 1 million. So 1,025,000 will be out of the money. So the seller has some room to be wrong but still make money. So for example, within the next 60 days, if the price of the land increased by about $10,000 only, then the seller has made a profit of 15,000. Again, another example, if the price of the land increased by $20,000, then the seller has made 5,000. So the seller has some room to be wrong but still make money. On the other hand, if the price of the land stays flat or perhaps goes down a bit, the seller gets to keep the entire 25,000. He also benefits from time decay, because every day that passes and the price of the land has not moved, the seller is benefiting from this environment. We now look at profit and loss diagrams for both the buyer and the seller positions. Profit and loss diagrams are a critical tool to understand your options positions. Every options position will have P&L diagrams, and everyone should compare these to a map. These diagrams show you how your positions will lead you to profit. Every course in our courseware will look at profit and loss diagrams very closely, so you're going to be seeing a lot of these. This is the profit and loss diagram for the call option buyer. On the x-axis is the price of the asset. You can see there's a 0 on the left-hand side and then higher values on the right-hand side. The vertical dotted line in the middle is the strike price of $1 million. On the y-axis, we have profit and loss. Anything above the 0 line that you see in the middle there is profit, and anything below the 0 line is losses. The 0 line is the separator between profit and loss, and on every P&L diagram, even in the actual options trading platform, you will see the 0 line on the y-axis, and it separates your profit from your loss. Whenever your P&L diagram goes above the 0 line, you're going to see profits, and whenever your P&L diagram goes below the 0 line, you're going to see losses. So if the price of land is below $1 million, then the buyer has a maximum loss of $25,000. So we're looking at the black line now. And if you see anything below $1 million, the buyer is going to have a maximum loss of $25,000. So what does this black line represent? This black line represents your P&L position at the time of expiry. So this is very critical. It represents it at the time of expiry. So assuming 60 days have transpired, we are looking at the black line, and that's going to tell us what the position is depending on where the price of land is at the end of the 60 days. So anything below $1 million or even at $1 million, the maximum loss for the buyer will be incurred at that point, which is $25,000. Anything above 1.025, the buyer is going to have gains depending upon where the land price is when that option expires. So if it went up to $1.1 million, that point could be somewhere here, and that would represent a profit of about $75,000. And then if the price of the land went up to $1.3 million, that point may even be off the chart on this one, but let's just say it's over here, and that would represent a profit of $275,000. Anything between $1 million and 1.025, we've seen that the buyer will still have a loss. It's not going to be a max loss for him, and the seller will still have a profit, but it's not going to be the maximum profit. So we just looked at the previous slide and we said if the price of the land went up by $10,000, then the seller will still have a profit of $15,000, and likewise the buyer would lose that $15,000. If the price of the land went up by $20,000, the buyer would lose $5,000, and the seller would profit by $5,000. So this is how we look at P&L diagrams. Similarly, now let's look at the P&L diagrams for the seller. Intuitively, this looks exactly like the opposite risk-reward profile of the buyer. And it should be, because risk and reward profiles of any position is shared between the buyer and the seller. There are no other parties to the option contract. Everything is shared between the buyer and the seller. Again, we look at the dark black line. Anything below $1 million, at $1 million or below, the seller is going to make a full profit of $25,000. And on the downside for the seller is, the downside for the seller comes if the price of the land keeps going up. So anything above 1.025, the seller starts to accumulate losses. And anything in between, the seller still makes some profit and the buyer will make some loss. But it won't be a maximum profit for the seller and it won't be a maximum loss for the buyer. The important thing to realize here is that the seller is exposed to unlimited losses on the upside. So if the price of the land continues to go up, the seller is going to be losing a lot of money. On the flip side, his profit is limited, and that's limited to the $25,000 that he paid in premium. So this is how we look at profit and loss profiles from both the angles of a buyer as well as a seller. Let's now look at the expiry and settlement obligations of both the buyer and the seller. So both buyer and the seller must close their positions by expiry, because this options contract has a finite life, and that is 60 days. So the maximum this option contract can be alive is for 60 days. In the financial world, we can close our positions by either exercising or by cash. And on the day of expiry, all extrinsic value of the option will go to zero. So, and this should make sense, because there is extrinsic value is time value, and there is no time left when we have approached the date of expiry. If the option is in the money, it will have some intrinsic value. So we looked at the examples before. Let's say the price of the land increased by $10,000. So it went up from 1 million to 1,010,000. So the intrinsic value of that option will be 10,000, and there'll be no extrinsic value. All time value will get reduced to zero. Similarly, if the price of the land went up by 20,000, then 20,000 will be the intrinsic value on the date of expiry. If it goes up by 100,000, then its intrinsic value is 100,000. So the buyer can always sell this option on the date of expiry and capture this intrinsic value. If the buyer wants to exercise his option at $1 million, then the seller is obligated to sell the land at $1 million. Both the buyer and seller can close out their positions anytime, and this obviously applies to a real options market and not to a real estate example that we looked at in this example. There is obviously no real estate options market. So let's just review the call options. A call option gives the buyer of the option the right to buy and the seller of the option the obligation to sell. Buyer pays a premium for this right, and his profits are unlimited and his losses are limited to the premium he pays. But the stock must move in a bullish direction for him to make profit. Seller receives a premium and his profit is limited to this premium. His losses are unlimited if the stock goes higher. From his perspective, the stock can remain flat or go bearish. Options are wasting assets and they do lose value every day to time decay. Now, we've not touched upon time decay yet, but it's important to just understand right now that time decay is a buyer's enemy and a seller's friend. There are three kinds of options: in the money, out of the money, and at the money. And all three have different prices and they have different probabilities for success. In the money options have intrinsic and extrinsic value, and at the money and out of the money options have only extrinsic value, which is also called as the time value. So we've looked at call options using a real world example. Now it's time to go into the platform and look at real Apple options. So the next two chapters are going to be focused on this. Chapter 2 is going to look at options from a buyer's perspective, and chapter 3 is going to look at it from a seller's perspective. We are going to look at real Apple options, and we are going to study in the money, out of the money, and at the money options. We look at various aspects of an option like the premium paid, the strike price, the expiry date, as well as its profit and loss graphs. Hopefully this real world example has been a good example for you to understand what a call option is. And in the next course, we are going to look at put options, and we'll do the same thing. We'll be taking a real world example of a put option, and you should know now that a put option is going to work exactly at the opposite of a call option. A call option gave the buyer of the option the right to buy, and a put option gives the buyer of the option the right to sell. Again, all of this can be a little confusing. This is very normal. I don't want you to get intimidated by any of this language because it is confusing, and there isn't an options trader today alive who has immediately understood all of this on day one and have become an options expert in a matter of a couple of months. That just does not exist. So every options trader has gone through these challenges. So it's very normal to be very confused at this point. But we are going to walk through every one of these issues very slowly, and I'm going to explain all the different parameters of options in this module. So by the end of this module, you should have a good idea of all the theory behind options. And I'm going to use real world examples to explain the concept and then take you into the trading platform to show you the concept in real life, in the financial markets. So that's what we are going to do. A put option is exactly the opposite of a call option. So if you think a stock is going to go down, you buy a put option. Okay? So that's the end of chapter 1. And if you have any questions on this, please email us at info@hackertrading.com. But I'm going to see you on chapter 2, where we look at the buyer's perspectives, and then finally chapter 3 of this course. Thank you. I'll see you there.